referrals. Referrals are huge. Like, I want to make sure that other investors are actually happy. The more referrals, the better. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello, and welcome back to Pillars of Wealth Creation. I am your host, Todd Dexheimer. Excited to have you back here. And I want to talk about something that I just saw. So, unfortunately, this happens from time to time, but we find that there's a bad actor in the industry. It happens in every industry. It happens in real estate. It happens in finance. It happens everywhere. It happens in clean energy. It doesn't matter where it is. We find, bad actors, bad companies, it just happens, but it stains the industry for a while. And right now, we just saw that the SEC last month filed a complaint against a gentleman, Drive Planning, and a $300 million of investor money is gone. Now, that's in and of itself, it's of course not good, right? You don't want to lose investors' money, but if it happens, what happened, right? Could it be excusable? Well, it's never fully excusable. There's always accountability, right? We got to say what happened in the situation and why did this happen poorly. And somebody's going to take responsibility. It's ultimately the operator that's got to take responsibility. The business owner's got to take responsibility. But this case, it was fraudulent dealing. It was taking investor money and buying private jets, buying expensive clothing, yachts, jewelry, spending money on marketing in order to continue to raise money and bring more money in, and never using that money on a business that didn't really exist. It was a business in just in the air, right? It was this, hey, we're going to provide you awesome returns, 10% quarterly returns per quarter. So 40% annualized returns. We're going to provide you these 10% quarterly returns. And this was a business that was a real estate acceleration loan business. Yeah, so this business is sitting there, real estate acceleration loan company, and people are investing in it, and people are excited about these huge returns on the deal, but the return, their investment dollars are literally being pocketed by the owner, the scam artist that's taking and buying a ranch, going on, huge, expensive, lavish vacations and buying jewelry and who knows what else. So this scam artist is offering these great returns, and the thing is, people were attracted to it because he had this huge presence on social media, big marketing, beautiful marketing, right? Offering these big returns, and also had a book out there, a book called Bulletproof Your Finances. And so, of course, he's an expert. Everybody thinks he's an expert, and they don't do their due diligence. My guess is most of these investors didn't actually vet the sponsor. They saw the marketing, they maybe read the book, they saw that he had a social media presence. And they go, "Wow, this guy obviously we can't go wrong with him. He's got such a public presence. He wouldn't do anything wrong." And I think that's what happens a lot, is that people have such a presence and are so well known that you think, nothing can go wrong with them. And they think, well, they're not going to do anything to damage their reputation. Well, if they're bad people, they don't care about their reputation. If they're greedy, bad people, their reputation really doesn't matter that much. They're corrupted by greed. And so that's not what they look for, right? They don't care. They just want more money. They want you to give them money so they can go and blow it on stupid crap, right? So how do you protect yourself? How do you not get caught up in something like that, in this This wasn't necessarily a Ponzi scheme, but basically a Ponzi scheme, right? And it can be difficult, but we can say, well, I just won't invest in this type of stuff. Okay, well, that's one way. You could hide your money under a mattress or put it in a bank, but look, I mean, if you had your money in certain banks, they go under, and if you have more than $250,000, it's not necessarily protected, right? If you have money in stock market, the companies go belly up all the time. I am invested in the stock market, and I invest in all kinds of different companies. I don't do much with like index stocks and things like that. I invest directly in businesses. I've had several companies that my stocks have went to zero on. I've had many others that they've went up drastically, but you can never fully protect yourself. So even if you're, you know, going public to try to shoot, if you're doing government bonds, are we sure that the government is gonna? Are we sure about that money right now? I don't know. I'm not so sure. So I don't feel too comfortable there either. I think I think there might be a Ponzi scheme happening there with our government money. But I digress. So, what can you do other than saying, "Well, I'm not going to invest in stuff like that"? No, let's continue to be smart. Let's continue to invest um, in opportunities that make sense. But we have to think about a few things. First of all, fancy marketing and a big social media presence and um, you know, a book, those those are great, would be great, but they don't mean anything other than that person is a great marketer, right? That company is great at marketing. And that's all it means, really. It doesn't mean much more. Now, if they're doing a good job, maybe educating and all that kind of stuff, that okay, then they maybe have some knowledge. But again, it doesn't mean they're a straight player. And so that's one thing to look out for is how fancy is their marketing? Okay. Again, I don't want to tell you just because they have great marketing means they're a scam company because that's just not true. But sometimes does their marketing feel too good to be true? Is it, wow, these returns are amazing? Like those are things that you really want to look out for. One of the things I look out for, like 10% per quarter. Are you kidding me? Like that's amazing. Those are amazing returns. Everybody should be doing that. I should have invested in that. 10% a quarter, 40% annualized. Like that's a no-brainer. If you could guarantee me those returns, I'll quit what I'm doing right now and put all my money into that and just collect that and keep on investing in that. Right. I don't know. I don't know what else to say other than that's amazing. But it's too good to be true. And so that right there in and of itself should be the red flag. And what happens is these investors, hopefully you're not one of them, they get wide eyed with returns and they go, whoa, that's a great return. I want that. And I'm going to invest in that. And that's all the due diligence they do. Literally, that's all the due diligence. Oh, this person, maybe they did the due diligence of, oh, they got a book, they got good social media presence. Okay, legit. Okay, they're legit. I like this company. I'm going to invest in it because of these returns. I see it all the time. Like I talk to investors, by the way, like this quite a bit. And I talk to investors that are not investing in one of our deals because we're offering a 15 to 17 IRR and somebody else is offering 20 to 23 IRR. Ooh, and that's so much better. Maybe the answer is it could be, or it could just be that they're way less conservative. They are overlooking a ton of things. They're, they didn't do good due diligence. They're sitting here projecting exit cap rates that are just unrealistic, right? Rent growth that just won't happen, right? Renovation to rent increases that are impossible, right? And so maybe the returns are better. Maybe they're actually much worse. And so that 20 to 23 IRR, although it's projected, is that actually going to happen, right? My 15 to 17. Now, again, it could just be smoke and mirrors too. So we don't want to just assume because that's a low return that it's good. Still want to do our due diligence on that. But if you're seeing really high returns, 20% IRR doesn't scare me. That doesn't mean necessarily that's a bad deal. I also don't think it necessarily means it's a good deal. It's actually something, a 20% IRR that's being projected is something that gives me a little bit of pause to say, why are they projecting so high? In my opinion, it should be somewhere in the teens, but it's just something that I go, okay, well, I got to look a little bit harder in this and why are they projecting that? How confident do I feel that they can actually hit that? And maybe I say, well, they can't. Well, maybe again, that not necessarily a bad thing, but if I see something like 40% annualized, right away, I would just, I personally would have taken that deal and that would have been in the garbage. Like I wouldn't have even looked at it because it just doesn't attract me. It's just, in my opinion, spells likely fraud or doing something wrong. Okay. Now, I shouldn't say that completely because there are a few instances where that could be right, but especially real estate related, like that's not going to happen. Tech company, okay, could we have projected that, like, look, guys, this could quadruple in value in 12 to 24 months? Sure, but that's like blue sky, right? We have that potential, but then you're also knowing that, look, I'm investing in a super high risk investment, and yeah, my $50,000 that I'm putting here could quadruple, could, 10x, but it also could go to zero. Like, I just know that that's reality. Like, if the founder sends me an email and says, "Hey, unfortunately, we're closing the doors," I already knew that that was a possibility, right? I knew there was a, you know, 40% chance that that would happen, right? One in 10 businesses, sorry, one in 10 businesses succeed. I knew I was investing in something risky. But in this case, it wasn't put out there as risky. This was a real estate assumption loan program. So, like, it wasn't risky. It was bulletproof. Like the book says, bulletproof, right? So, how do we do this? Okay. So, first of all, watch out for big returns. The bigger the return, the more I would really be looking at why are we able to hit these returns. Second of all, referrals. Referrals are huge. Like, I want to make sure that other investors are actually happy. The more referrals, the better. I would prefer to meet some investors without even a referral from the sponsor. So one thing I would do is you can ask, let's say you know nothing about this company, you're researching them, you're doing your due diligence, you've called them, and then you ask for referrals. You don't know any other investors. You weren't referred to them. Okay, so you call the referrals, and let's say they give you three referrals. I'm going to call that referral investor and I'm going to say, do you know anybody else that is invested with this company that you could refer me to? And I'm going to do that with all three of them. Hopefully, I get one or two more, and then I can even do that to those people. So hopefully, I can get, 4, 5, 6 referrals, and hopefully, at least one or two of those referrals aren't referred directly from the sponsor. And so that would be really valuable for the referrals. And make sure, like in this instance, like, is this company even real? Have you seen these returns? What do you think about their communication? What red flags have you seen? What are you not happy with? What don't they do well? Those types of questions. Uh, Background check is another thing you can do. Now, it's potentially going to cost you some money, but you can do a background check on one or all of the owners to make sure that there's no funny business happening there. What does that tell you? Again, I mean, it maybe doesn't tell you everything. Just because they haven't been caught or just because they haven't done anything wrong up front doesn't mean they can't do it in the future or they aren't doing it right now and just haven't been caught. But at least that's another layer of protection. What's their history? And this is super important. Like this company, like, have you actually done anything? Like there wasn't even a real company. Like, have you paid these returns? What kind of profits have you made? What are your expenses? Like, what's your history? behind this. And so if you're dealing with like a company like mine, a multifamily investment company, like, look, what's your, how many deals have you done? How, have you gone a full cycle on any deals? Have any deals gone wrong? Like, have you lost any money on deals? Have you had deals that haven't hit pro forma? Do you have any current deals that are performing well? Those are great questions to ask. Now, because they say yes to some of those, hey, yeah, we have some deals that aren't going quite as well. Um, we do. We have deals that don't go as planned. But what's the explanation? First of all, were they honest with you? And then what's the explanation behind that? Why didn't it go well? What have you learned from it? Why does this deal that I'm currently in, why is it going to be different from that deal? Why is that not, why is the same thing not going to happen? Look, if you got a deal that didn't go so well, and it's because of, the interest rates that went up, but now this new deal is a fixed rate deal. Okay, that's different. We got a different story behind it. So, what's the history? What's went well? What's been gone not so well? One of the best questions I think investors ask me. One of the questions if investor says, "What question didn't I ask you?" And if they didn't ask it, is what's gone wrong? Tell me what's gone wrong on some of your deals and how have you changed what you're doing today? And it better be something has gone wrong. They better probably say a lot has gone wrong, right? And here are a couple things, but I want to know what's gone wrong and how have you fixed it? It needs to be something serious. What are the risks associated with this deal? They need to tell you risks associated. If somebody says there's no risk or, oh man, this deal is bulletproof, like, forget it. No, there's definitely some risk. Look, we just purchased a property. I would say very low risk deal, but I have investors that ask me what are the risks of the deal. Okay, well, easy. This is an older building. Older buildings inherently have more potential problems. We've done our due diligence. We know that the plumbing's in great condition. We know that the HVAC's in good condition. We know the age of the roofs. We know all this kind of stuff. However, I know just because the building is older that even though the plumbing looks like it's in good condition today, doesn't mean it's not going to spring a leak. Doesn't mean a pinhole's not going to form that we didn't see, or maybe it's already formed. We didn't see it. And then so now we have to dig up the ground and fix it. So what did we do to set aside and mitigate that risk? Well, we set aside a ton of money for those types of things. So what's the biggest risk? Well, the biggest risk is the age of the property and the condition of the mechanics within the property. We have set aside extra funds to be able to deal with those challenges. However, if more things go wrong than what we anticipated, that is a risk, right? That is definitely a risk for our capital. And could there be a capital call? Well, we think no, we think there likely wouldn't be, but could there be? Sure. If a lot of stuff went wrong, we could have to need more capital. Now, we as sponsors would put our own money in first, of course, and look for other sources. But you want to understand what that sponsor sees as risks and what they see as the solutions to those risks. The other thing is how much capital do they have invested in the deal? You want to make sure they have their own money invested in the deal, and that they're not just counting on investors, right? Um, do they have have they had third party verification, any kind of third party verification of their assumptions, right? When we're talking about um, value add multifamily, you know w- do we have rent comps? Do we know that we can actually and then verify that these are true rent comps, that these are true sales comps? One of the things I see people do is they use rent comps and sale comps of deals that were several years old, like a sale comp of something in 2022. Well, that's no longer a sales comp. Like the market's gone down 25%. I saw a deal recently. They were using a 2022 sales or sales comp. Like, come on, that the property sold for 200 a door, but now that same property would sell for 165 a door. Like, that's not a sales comp. Let's be real, right? So, are they the same sales comps, or in the same neighborhood, or the same rent comps in the same neighborhood? Like, what's our verification process for how we came up with our numbers? All right. So those are a few things. There's plenty more. Do your due diligence, vet your sponsors, vet your deals, understand what you're doing. And if you are a sponsor, if you are doing deals yourself, if you're an investor, you're trying to take other people's money for your deals, make sure you're being diligent and make sure you are checking the boxes of what to really look out for so that when you do present it to your investors, not only A, are you successful with your investors in raising capital, but B, you are actually truly protecting your investors' money. Because the last thing we want to do is have a deal that doesn't work out, right? It not only ruins your reputation, it ruins investors' investments, and nobody wants to do that. So be diligent, vet properly, and of course, just be a good person. Don't be fraudulent. Like that's terrible. It's disgusting. I can't believe somebody does that. Well, I can believe it, but it's just disgusting. It's disturbing. Anyways, not all investments are bad, so continue to move on. Uh, yeah, that's it. Make every day a Saturday. Have a fantastic rest of the day. Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.